One push. That is all it takes. One small shock in the wrong place, and the entire financial system begins to slide. Not slowly, not over months, but in hours. And when it starts, there will be no pause button. No emergency rescue big enough. No central bank powerful enough to catch what is falling. Because this time, the system is already leaning. In 2008, the collapse started with a single institution, Lehman Brothers. One bank failed and the shock rippled outward. Credit froze. Markets panicked. Jobs vanished. But behind the scenes, governments still had room to act. Interest rates were high enough to cut. Balance sheets were clean enough to expand. Debt was low enough to absorb trillions in bailouts. That safety net no longer exists. Today, every major economy is carrying record debt. Every central bank has already used its most powerful tools, and every market is more tightly connected than ever before. When something breaks now, it will not stay contained. It will cascade. Let's rewind for a moment. In 2008, global debt stood around $140 trillion. It sounded massive at the time, but it was manageable relative to the size of the world economy. Governments could borrow, central banks could print, investors still trusted the system. Today, global debt is well over $250 trillion. That is not growth, that is leverage, stacked on top of leverage. While the global economy expanded slowly, debt exploded. Households borrowed more, corporations borrowed more, governments borrowed at a pace never seen in peacetime. Entire financial markets became dependent on cheap money staying cheap forever, and now interest rates are no longer near zero. That single change is enough to stress everything. When rates rise, debt becomes heavier, refinancing becomes harder, asset prices fall, and suddenly loans that looked safe start cracking. This is exactly how 2008 began. Back then, it was homeowners who could not refinance their mortgages when teaser rates expired. Housing prices dropped. Defaults rose. Banks holding those loans started bleeding. Today, the same mechanism is playing out across the global economy, just on a much larger scale. Companies that borrowed trillions during the eras of free money are now facing higher interest costs. Governments that rolled over debt endlessly at near zero rates are now paying dramatically more just to stay afloat. Entire sectors built on cheap credit are starting to wobble. And one sector in particular is already cracking: commercial real estate, office towers, shopping centers, apartment complexes, the financial backbone of regional banks across the United States and Europe. During the pandemic, remote work permanently reduced demand for office space. Companies downsized. Leases were not renewed. Vacancy rates surged. But the loans backing these buildings were taken out when interest rates were near zero and property values were much higher. Now those loans are coming due. Hundreds of billions of dollars must either be refinanced at far higher rates or paid off entirely. And in many cases, the buildings are worth far less than the debt attached to them. Which means refinancing is impossible. When owners cannot roll over loans, they default. Banks take the properties, but the properties are worth less than the loans. Losses pile up, and those losses sit directly on bank balance sheets. This is not a small problem isolated to a few bad investments. Hundreds of banks have major exposure to commercial real estate. For some regional banks, over half of their entire loan portfolio is tied to these properties. If commercial real estate continues falling, those banks do not just take a hit, they fail. And when banks fail, credit disappears. Businesses cannot borrow, payrolls get cut, investments stop, consumers pull back. The economy slows rapidly. This is how recessions turn into crises. But here is where today becomes far more dangerous than 2008. Back then, the housing crisis was largely concentrated in one asset class in one country. Today, stress is everywhere at once. While commercial real estate weakens in the United States, property markets in China are already imploding. Developers are defaulting. Local governments are drowning in debt. Banks are quietly absorbing massive losses. China's slowdown is now dragging down global demand. Commodities are weakening. Export-driven economies are slowing. Corporate profits across the world are under pressure. At the same time, government debt levels are reaching historic extremes. Many countries are now spending more on interest payments than on education, infrastructure, or healthcare. This is what happens just before financial systems snap. When growth slows while debt costs rise, deficits explode. Investors begin questioning whether governments can keep borrowing forever. Bond yields rise, which makes debt even harder to sustain. And that feedback loop accelerates very quickly. This is how sovereign debt crises begin, and here's the terrifying part. In 2008, central banks stepped in as the ultimate backstop. They slashed interest rates to zero. They printed trillions of dollars. They stabilized markets. Today, they are trapped. Rates are still elevated compared to the last crisis. Inflation remains a threat. Balance sheets are already bloated from years of money printing. If central banks cut too aggressively, inflation can surge again. If they do not cut, debt collapses start spreading. There is no painless option. The tools that saved the world in 2008 have already been used, over and over. which means when the next wave of failures begins, there will be far less power left to stop it. And unlike 2008, where panic unfolded over months, today's financial system moves at digital speed. Money leaves banks with a tap on a phone. Algorithms sell assets in milliseconds. Social media amplifies fear instantly. The next crisis will not creep. It will surge. One shock will trigger another. Bank stress will lead to market crashes. Market crashes will freeze credit. Frozen credit will crush businesses. Business failures will hit employment. Government revenues will fall just as debt costs rise. Everything feeds everything else. This is why this crash will be faster than 2008. Not because people are reckless, but because the system is tighter, more leveraged, and more interconnected than ever before. And because the safety nets that once stopped collapse are already stretched thin. We are not standing at the beginning of a single problem. We are standing at the edge of a chain reaction. And once it starts, there will be no clean way to slow it down. In the next part, we will walk through the exact domino sequence, how banking stress, debt pressure, global slowdown, and policy exhaustion connect into one accelerating collapse, and why the early warning signs are already flashing right now. Picture the system like a row of tightly packed blocks, each one heavier than the last. When the first begins to tilt, it does not fall alone, it pulls the next, and each impact accelerates the one after it. This is how modern financial crises actually unfold. Not as one dramatic explosion, but as a rapid chain reaction where stress jumps from sector to sector faster than policymakers can respond. The first block already moving is commercial real estate. As buildings lose value and loans come due, defaults rise. Banks absorb losses. Balance sheets weaken. Investors start asking uncomfortable questions. Which banks are exposed? How big are the losses? Who is next? And once those questions start circulating, confidence disappears. Depositors move money, stock prices fall, credit ratings get downgraded, funding dries up. Banks that looked stable on paper suddenly face liquidity pressure. This is exactly how regional banks collapsed during recent banking scares, not because they were instantly insolvent, but because trust vanished faster than assets could be sold. Now imagine that same dynamic playing out across hundreds of banks at once. That is the scale commercial real estate is capable of triggering. But it does not stop there. When banks tighten lending to protect themselves, the real economy feels it immediately. Small businesses lose access to loans. Construction projects freeze, hiring slows. Consumers struggle to refinance mortgages and credit cards. Spending drops. Economic growth weakens, which leads to layoffs, and layoffs lead to even lower spending. This feedback loop is what turns financial stress into recession. But while this unfolds in the United States and Europe, another block is already crashing on the other side of the world. China's property sector. For decades, Chinese growth was fueled by real estate development funded by enormous debt. Entire cities were built on borrowed money. Apartments were sold before construction even finished. Local governments relied on land sales to survive. Banks poured credit into developers, and households stored most of their wealth in property. It worked as long as prices kept rising. But once demand slowed and debt loads became unsustainable, the bubble began to deflate. Major developers defaulted, projects stalled, homebuyers lost confidence, prices started falling. Now the entire sector is contracting. And because real estate made up such a massive share of China's economy, the slowdown is spreading everywhere. Manufacturing weakens. China consumes enormous amounts of commodities: oil, copper, iron ore, coal. As its economy slows, global demand falls. Commodity prices drop. Countries that rely on exporting raw materials suffer immediate revenue shocks. Brazil, Australia, Chile, South Africa, Indonesia, their currencies weaken. Debt becomes harder to service. Capital flows out. This is how emerging market crises begin, and when emerging markets wobble, global banks with exposure take losses. Investment funds face redemptions. Markets grow volatile. Risk appetite collapses. Suddenly, investors are no longer chasing returns, they are chasing safety. Money floods into government bonds, then quickly reverses when debt fears rise. Volatility spikes. Stock markets slide. This brings us to the next block in the chain: sovereign debt. For years, governments borrowed freely because interest rates were low, and investors assumed central banks would always step in if trouble appeared. But now debt levels are far higher and borrowing costs are rising. Many countries are running massive deficits just to pay existing obligations. As growth slows from banking stress and global slowdown, tax revenues fall. At the same time, interest expenses climb. Budgets strain. Credit ratings come under pressure. Investors begin demanding higher yields to hold government bonds, which raises borrowing costs even further. This is the dangerous spiral that precedes debt crises. Once markets lose confidence in a government's ability to manage its finances, selling accelerates, bond prices drop, yields spike, funding becomes unsustainable, and eventually defaults or emergency bailouts follow. And we have seen this before in smaller economies, but this time, the risk is spreading into the largest countries on Earth. When heavily indebted nations face stress simultaneously, The entire global financial system feels it. Banks hold government bonds as safe assets. Pension funds depend on them. Insurance companies rely on them. If sovereign debt starts wobbling, the foundation of the financial system cracks, and this is where the illusion of safety disappears. In previous crises, investors believed government bonds were untouchable. Now, rising debt and political gridlock are making that assumption weaker. If trust in sovereign debt erodes, there is nowhere left to hide. In every major crisis of the last century, there was always one force that eventually stopped the freefall: central banks. When markets panicked, they stepped in. When banks froze, they flooded the system with money. When confidence collapsed, they became the buyer of last resort. This is what saved the world in 2008. But the conditions that made those rescues possible no longer exist. Back then, interest rates were high enough to slash aggressively. Governments still had manageable debt. Central bank balance sheets were relatively small. There was room to maneuver. Today, that room is gone. Rates are already elevated after years of inflation battles. Cutting too quickly risks reigniting price surges that crush purchasing power and destabilize currencies. But not cutting risks widespread defaults as debt burdens become unbearable. This is the trap policymakers now face. Every move carries serious damage, and every delay allows stress to compound. Then there's the issue of money creation. For over a decade, central banks relied on massive asset purchases to prop up markets. Trillions of dollars were injected into financial systems around the world. At first, it worked. Liquidity returned, asset prices recovered, confidence stabilized. But with each round, the impact weakened. Markets grew dependent. Debt expanded faster. Speculation increased. And now balance sheets are already bloated. Printing more money no longer feels like emergency medicine. It feels like a permanent crutch. The danger is that further stimulus no longer restores trust. Instead, it threatens currency stability. Investors begin wondering whether governments are solving problems, or simply devaluing money to escape them. When that doubt appears, capital moves fast, currencies weaken, bond yields rise, inflation expectations jump, and financial conditions tighten instead of loosening. This is why central banks now face diminishing returns. The tools that once calmed markets can now inflame them, and markets know it, which makes panic harder to contain. But policy exhaustion is only part of the risk. The speed of modern finance multiplies it. In earlier eras, stress spread slowly. News traveled by newspaper. Bank runs took days. Market moves unfolded over weeks. Today, everything is instantaneous. Trading algorithms scan for weakness in milliseconds. Social media amplifies fear within minutes. Digital banking allows billions to move with a swipe. This creates feedback loops far faster than human decision-making. A rumor becomes a withdrawal wave. A sell-off becomes a crash. A policy announcement becomes global volatility within seconds. Once momentum builds, stopping it becomes incredibly difficult. This is exactly what happened during recent bank failures, where institutions collapsed in a single day. Not because assets vanished, but because confidence evaporated. Now imagine that process occurring simultaneously across banks, markets, and countries. There would be no breathing room, no time for committees to meet, no slow stabilization, just rapid contagion. And when panic spreads at digital speed, even strong institutions feel pressure. Investors sell first and analyze later. Liquidity disappears, prices gap lower, margin calls trigger forced selling, which drives prices down even further. This is how orderly markets turn chaotic, and chaos is what overwhelms policy responses. Another layer of danger comes from how interconnected global finance has become. Banks operate across borders. Funds invest worldwide. Supply chains stretch across continents. Debt is held by institutions everywhere. This means stress in one region instantly impacts others. A slowdown in China hurts exporters in Europe. Bank losses in the United States shake confidence in Asia. Sovereign debt fears in one country ripple through global bond markets. There is no isolated crisis anymore. Everything is systemic. This is why modern collapses accelerate. Every shock transmits through dozens of channels at once: financial, economic, psychological, political. And speaking of politics, that pressure rises sharply when economies weaken. As unemployment grows and living costs remain high, frustration builds. Governments face public anger. Populism strengthens. Policy becomes reactive instead of strategic. Trade barriers go up. Spending promises increase. Debt grows faster. And long-term stability takes a back seat to short-term survival. When systems reach this level of stress, the future no longer follows a single path. Instead, it branches into outcomes that depend on timing, confidence, and how quickly pressure spreads. Some scenarios look painful but manageable. Others spiral, and some reshape the global economy for a generation. The first possibility is what policymakers hope for: a slowdown without collapse. Commercial real estate weakens, but banks quietly extend loans rather than foreclose. Losses are spread out over years instead of realized all at once. China injects stimulus to stabilize property markets. Growth slows, but does not contract deeply. Central banks trim rates cautiously. Markets correct, but avoid free fall. In this world, households feel pressure. Businesses tighten budgets. Unemployment rises modestly. But the system bends instead of breaking. Debt remains high. Growth remains sluggish. And the next crisis is simply postponed. This is the softest landing. But it requires coordination, calm, and a great deal of luck. The second path is far more likely, a rolling crisis. Instead of one dramatic collapse, stress emerges in waves. A regional bank fails, markets shake, authorities intervene, calm returns briefly. Then another institution shows cracks, another sector weakens, another country faces debt pressure. Each event alone seems manageable. Together, they grind confidence down. Businesses delay investment, consumers pull back spending, hiring slows, recession takes hold. Volatility becomes the norm. Asset prices drift lower over months rather than collapsing in days. This kind of crisis is exhausting rather than explosive. It wears down households and companies slowly, leaves scars on growth, and it usually ends with even more debt piled on top of the old. This is how long stagnations begin, but there is a third path, and it is the one markets fear most. Multiple shocks hitting at once. Commercial real estate losses accelerate faster than expected. A major bank fails unexpectedly. China's slowdown deepens into contraction. Commodity prices plunge. Emerging markets face capital flight. Government bond yields spike as investors question debt sustainability. All of this unfolds within weeks instead of years. Confidence breaks, liquidity disappears. Selling feeds, selling. Margin calls, force liquidations. Funds dump assets regardless of price. Markets gap lower day after day. Central banks rush to respond. Emergency meetings, rapid rate cuts. New asset purchase programs, public assurances. But instead of calming markets, fear intensifies. Investors worry about currency stability. They worry about inflation returning. They worry that debt is spiraling out of control. Bond markets rebel. Yields rise even as central banks buy. Currencies weaken. Capital flees to perceived safe havens. Gold surges. Cash becomes king. Global trade slows sharply as financing dries up. Companies slash payrolls. Consumers retreat. Governments scramble for stimulus they can barely afford. This is how recessions turn into systemic crises. Today, weakness travels across borders in real time. Supply chains seize up, financial markets synchronize, consumer sentiment collapses globally. This creates synchronized downturns, and synchronized downturns are far harder to stop. Another factor that magnifies risk is how dependent asset prices have become on constant support. For years, markets operated under the assumption that central banks would always step in during trouble. This belief encouraged risk-taking. It justified high valuations. It fueled massive borrowing. But if that belief cracks, if investors begin to doubt that rescues will work, behavior changes dramatically. Instead of buying dips, people sell rallies. Instead of trusting stability, they prepare for volatility. Instead of holding long-term assets, they rush for liquidity. Once this shift happens, markets no longer rebound quickly. When major crises arrive, they rarely come without warning. The signals appear quietly at first, small shifts that most people ignore, numbers that move just enough to seem unimportant. But taken together, they reveal when stress is turning into something far more dangerous. One of the earliest signs is in currency markets. When investors grow nervous, they rush toward perceived safety. Capital flows shift rapidly. Exchange rates swing sharply. These moves reflect fear long before stock markets collapse. Another warning emerges in government bond yields. When yields begin rising despite economic slowdown, it signals investors questioning debt sustainability. It means trust is eroding. It means the foundation of the financial system is under pressure. Credit markets provide another crucial clue. As conditions worsen, riskier borrowers must pay much higher interest to attract lenders. When those spreads widen quickly, it shows that defaults are expected. Lending freezes soon follow. Bank stocks also tell a powerful story. They fall before recessions deepen because investors see loan losses coming. Sharp declines in financial shares often precede broader market breakdowns. Commercial real estate data is another pressure gauge. Rising delinquencies and foreclosures show when property stress is spreading into banking systems. This is where financial slowdowns often transform into crises. Unemployment trends reveal when economic damage reaches households. Once job losses accelerate, consumer spending drops sharply, reinforcing downturns. Volatility indexes reflect fear in real time. When they surge, it shows markets bracing for extreme swings and instability. And finally, overall market valuations relative to economic output signal when bubbles meet reality. When prices stretch far beyond sustainable growth, corrections tend to be violent. Individually, each indicator can fluctuate harmlessly. Together, they form a warning system. When several begin flashing at once, it means pressure is building rapidly. This is how crises announce themselves, not with sirens, but with patterns. Now let's bring everything together. In 2008, a housing bubble burst and exposed fragile banks. The government had room to respond. Central banks had powerful tools. Debt was manageable. The system bent, then it recovered. Today, the world stands on a far more fragile foundation. Debt is higher than ever. Markets are faster than ever. Confidence is thinner than ever. Commercial real estate is weakening. China's growth engine is slowing. Sovereign debt burdens are rising. Central banks are running out of effective tools. And global finance is so interconnected that stress travels instantly. This is why the next crash will be faster than 2008. When pressure builds now, it moves like a chain reaction. One sector tips another, one failure triggers the next. Fear multiplies through digital speed, and policy responses arrive weaker each time. The world is no longer dealing with a single fragile pillar. It is balancing on many strained ones simultaneously. That is what makes the coming downturn so unpredictable and so powerful. Yet, history also offers an important reminder. Economies adapt, markets recover, human innovation continues. Even the Great Depression eventually ended. The financial crisis of 2008 eventually gave way to growth. Painful periods reshape systems, but they do not erase them. The danger lies not in acknowledging risk, but in ignoring it. Preparation is what separates those who panic from those who navigate storms. Understanding how crises unfold allows smarter decisions. Diversification reduces vulnerability. Maintaining emergency savings creates resilience. Avoiding excessive debt preserves flexibility, and staying informed prevents emotional reactions. No one can predict the exact moment when stress turns into collapse, but the forces pushing the global economy toward turbulence are already in motion. The dominoes are closer than they appear. The difference between 2008 and the next crash is not just size, it is speed. When the shift begins, it will not unfold slowly on evening news broadcasts. It will race across markets, banks, and households almost instantly. That is the reality of modern finance. This is not about fear, it is about awareness. The world is entering a period where volatility is likely to replace stability, where leverage meets limits, where decades of easy money face economic gravity. Some outcomes may be mild, others may be severe, but the era of effortless growth built on endless borrowing is fading, and what follows will reshape economies, investments, and everyday life. The crash may not arrive as a single dramatic event. It may come as waves of stress building faster each time. But when momentum finally breaks, it will move quicker than anything we've seen before. That is why this crash will be faster than 2008. Not because history repeats, but because it evolves. And right now, the global system is evolving into something far more sensitive to shock. The question is not whether volatility is coming. It is how prepared the world will be when it does. Understanding the risks is the first step. Staying adaptable is the second. And recognizing that stability is never permanent is the third. The dominoes of the modern financial system are closer together than ever. When movement begins, it will travel fast. But those who see the patterns early will always have more options than those who react late. History does not repeat exactly, but it always leaves clues. And right now, those clues are everywhere.